Well, howdy there folks, and welcome into today's video. So today we're going to be looking at a stock that just crashed here after hours, which is called Stitch Fix, SFIX. And what we're going to do, we're going to listen to their latest conference call together that just happened about maybe 2 hours ago or so. So we're going to listen to this together, and by the end of this video, I'm going to kind of give my judgment on if this stock is a buy now or not a buy. Now this stock, look at this, it was $100 plus back in January. Now, this was the time period, once again, when it was peak FOMO in the market, right? January into the early part of February, peak FOMO in the market. Anything with growth was just going literally to the moon. And Stitch Fix was one of those companies that just went insane. I mean, this stock, you know, if we go back to 2018, this is around a $20 stock, right? You go to 2019, I mean, shoot, look at this. The lows in March of 2020, $13 or so, $11. Then it went on this epic run, 10x basically. The stock price 10x'd. And now it's just not in the best place. 52-week high, technically $113. And it just busted through another 52-week low, $20.47 after hours. So we're going to kind of do some research on the stock and look at a few things. And we're going to listen to this conference call together. And I'm going to give my 2 cents. And yeah, I hope you guys enjoy this. A little bit of a different video here today. Very, very different than what we usually do. So anyways, subscribe to the channel. If you're not already subscribed to this channel, make sure you hit that subscribe button. It's absolutely free to do so. Much love as always, guys. And also, just so you know, Moomoo has a pretty sick deal. I might have that as the pinned comment down there. I'll probably have it as a pinned comment. But basically, you get 5 free stocks right now, valued up to $3,500 each when you create an account with them. And I think you just have to make like any deposit. I think you could literally put like $1 or like $50 in your account or whatever amount and get 5 free stocks. So it's a pretty sick deal. So check out pinned comment down there while we go through this. All right. All right, guys. So let's start going through this.
Press release with details on our quarterly performance and outlook.
By the way, if you're wondering why am I listening to this through the Hungry Bowl, well, first off, we don't have a desktop site yet. Secondly, sometimes we lag like 24 hours on conference calls, so it's great if you don't have to listen to it live right now. We're actually hopefully going to get to a place within the next few months where we actually have conference calls. Like as soon as they're done, they're like up on the app. That would be amazing. But right now, they usually lag 12 to 36 hours depending on the company. So we have to listen to it through the investor relations page. It's all good.
In Q1, we delivered top-line revenue of $581 million, representing 19% year-on-year growth.
Right off the bat, 19% year-on-year growth. That's not bad at all. Like, geez, when I saw the stock down massively, busting through new 52-week low, I thought, maybe they stopped growing or something like that. 19% growth, that's not bad at all.
Also achieved our highest gross margin ever of 47%, along with $38 million in adjusted EBITDA.
47% gross margins, best ever? I don't want to say they sold me already, but goodness gracious, what in the world? What?
We ended the quarter with 4.2 million active clients, an increase of 11% from a year ago. At the same time...
So active clients went up 11%, revenue up 19%, so it sounds like they're making more money from their current clients.
Sequential net client additions were lower than prior quarters, and we are currently making changes to get this moving in the right direction. We are in a major learning phase right now as we build out our new Freestyle experience in full, and we opted in Q1 to be conservative with marketing spend as we optimize our new onboarding experience and conversion. I will discuss this more ahead. Today, I will first share highlights on the quarter and our recent launch of Freestyle. Then, we'll discuss why our approach is so highly differentiated in apparel retail. And finally, I will share our focus areas as we scale our ecosystem of personalized shopping, styling, and inspiration. First, on Q1, we've grown top-line net revenue for Freestyle 40% year over year. Freestyle penetration increased quarter over quarter as we continue to see our clients leveraging both Fixes and Freestyle, demonstrating the complementarity of our growing offering. We are also capturing more purchase occasions through Freestyle in product categories that have been underrepresented in Fixes, such as footwear, dresses, outerwear, accessories, and sleep and loungewear. Today, these categories represent $90 billion.
By the way, if anybody's confused on what Stitch Fix's main business model is, their main business model is basically they kind of use algorithms they use algorithms and your input on what they should ship you for clothes, what you kind of need, what would fit your styling, things like that. And over time, as you use the service more and more, the fits end up becoming better and better. Now, if you don't really care about clothes that much, Stitch Fix is probably not very relevant to you, right? But it is a pretty cool system if you care about clothing, you care about having different outfits and those sorts of things, which a lot of business professionals obviously do. And this is one of those services, if I was to guess their average client, income, I would say probably $70,000, maybe $90,000, something like that. If that's just my guess. I don't know for sure if that's accurate, but that's what I would guess. Their average client probably is in the $70,000, if not the $90,000 bracket of income, right? So somebody that's making some pretty good money.
In the U.S. women's market alone, demonstrating the opportunity ahead of us. In fact, footwear, accessories, and dresses together saw an over 50% increase year over year in Freestyle, which is 5 times the rate of growth we see in Fixes for the same categories in the same period. We also enjoyed growth in our Fix offering, which benefited from the first full quarter impact of Fix Preview, now rolled out to the U.S. and U.K. women's and men's client populations as of the end of Q4 FY21. As a result of our innovations with Fix Preview, we continue to see average order value increase, driven by strength in keep rates and continued satisfaction, with over 80% of our first Fix clients in the quarter purchasing at least one item and sharing that they look forward to their second Fix. When looking across both Freestyle and Fix,
that's an important number she just stated there, 80% keeping at least one item, because the last thing Stitch Fix wants is to ship you a bunch of stuff, right? And then you don't buy anything, or even worse, you never use the service again, right? So that's very, very important that the folks they have trying out this, for their first time, they actually like it and they enjoy the experience, and they keep getting fixes for, months or maybe even years to go. So the lifetime value of the customer is obviously much more. Very, very important.
New per active client topped $500 for the second quarter in a row and reaching a record high of $524.
$524 per hour.
Stepping back, this expansion into Freestyle represents an evolution of our business, which you can think of as Stitch Fix 2.0. There will be significant learning and experimenting to build this future of retail experience.
That's a term Wall Street doesn't usually like that much, experimenting. Because what that tells Wall Street is, hey, there's probably going to be some losses, there's probably going to be some write-downs, there's probably going to be some wasted time, right? Me, I hear that and I'm like, ooh, that sounds exciting, because they're going to find out some big stuff, right? But I can just tell you, Wall Street in general, fund managers, they don't like the word experimenting. That's just not a term they like at all, believe me.
Short-term impacts of cannibalization. We will be implementing new systems, and we are building new workflows. All of this learning of new motions is in service of building a great customer experience, and we will need to optimize these. We do not anticipate a linear journey. Specifically on new client additions, with Freestyle now available, in addition to our Fix offering, we are learning how best to route clients into the right experience for them. We've been testing client onboarding flows, whether a client comes directly to our main site or lands on a product detail page through paid search or other paid channels. We see significant new client potential ahead, as Freestyle enables us to act.
That is a problem for a business like Stitch Fix. Is that they historically, I've covered this stock for at least 1 or 2 years. I don't personally own any shares right now, but I might soon. But essentially, when it comes to a stock like Stitch Fix, one of their main ways they get customers is through social media. And from my understanding, social media ads have been which is good news for Facebook, good news for Google, but not good news if you're a company that gets a lot of your clients from, let's say, Facebook, Instagram, platforms like that, right?
Greater share of shopping occasions and has opened up new marketing channels for Stitch Fix to drive user acquisition. That said, and as I noted at the beginning of the call, our sequential net client additions were low for the quarter. We are at the early stages of this learning journey, and as a result of our testing in Q1, we experienced lower Fix conversion rates than we expected. We will continue to test and iterate the optimal client experience and conversion paths for new clients. During this learning stage, we will efficiently deploy our marketing dollars for learning, and we will scale them when the time is right. Now, on to our second topic, our differentiation. We are at the very beginning of this next chapter for Stitch Fix. To transform and evolve from our unique Fix model for styling clients into the global destination for personalized shopping, styling, and inspiration. The last 10 years of our Stitch Fix journey sets the stage for this future, with our highly differentiated approach to marrying data science and creative human judgment. Central to our model are rich data feedback loops that harness our millions of clients and their proactive relationships in sharing both preferences and many points of feedback on nearly every item we ship. For example, over 50% of Fixes include client notes with our stylists that inform emerging trends. Clients provide 5 points of feedback on over 80% of items shipped. And now, clients are providing a growing foundation of engagement data in our Freestyle experience. Similarly, Style Shuffle, our gamified rating experience in our app that 1 million clients play monthly, informs which items in our catalog will succeed with different clients. For example, within 48 hours of a new item being ingested into our product catalog, we have tested and understood the likely success rate of that item, informing which Fixes as well as which Freestyle shopping feeds are most likely to benefit from that item. These unique feedback loops enable a deep understanding of the drivers of customer preference and fit applicable in styling services and shopping. These loops are responsible for our strength and Fix keep rates over time, as well as contribute to the success of our exclusive brands. They also enable our Freestyle return rates to be materially better than other apparel e-commerce. To our knowledge, no other retailer is generating insights at this scale to inform a personalized shopping experience. Now, our final topic, where we are in our journey with Freestyle and Fixes and the areas of focus for the coming year and beyond. Over the course of Q1, we fully opened Freestyle to new consumers and began to market the offering. We enhanced the home feed experience to create many different entry points into shopping to help address the purchase intent of each client. From a growing number of branded curated shops unique to each client, to carousels on trending outfits for the client, to launches of new product lines including our Elevate Black-owned brand Grantees and the launch of Milton Made, our new sustainable and U.S.-built basics line. We also began testing influencer-curated pics as well as enabled clients to see more richness in our product detail pages with a growing foundation of...
They should be using, creators and influencers as much as possible, in my opinion. It sounds like almost they want to build their own brands, really.
All imagery. Going forward, we have 3 areas of priority for our continued build-out of Freestyle. First, we are strengthening the customer experience through product feature enhancements and expanded inventory selection. One key area of investment is reducing friction.
So it definitely seems like there's a lot of people that are short. Like generally you can get kind of a gist of just going on kind of a message board. Definitely seems like a type of stock that has a lot of people short this stock. So interesting.
Clients to access Freestyle through testing new onboarding approaches that balance personalization with speed of access into the experience. We expect this to be highly impactful work given only a fraction of our new traffic fully completes the style profile. Inside Freestyle, our secret sauce is styling on demand. Everything we show each client is unique to them and reflects what will best fit their body, represents as well as pushes the boundaries of each client's personal style, and provides value-added features such as
I got really excited there for a moment. I thought I was looking at calls and I was like, wow, $7 for $20 strikes. I was like, tomorrow might be at $5, but I was looking at $20 strikes here expiring January 2024. Looks like I have to pay around $11. After tomorrow, they'll probably be under $10. Shoot, it's intriguing at least, so something I got to consider.
Technically generated outfits. We have begun to make discovery easier for customers to find items they love. For example, we recently added a fresh finds category which clusters thematic items based on feature attributes tagged by our merchants and stylists, such as fall hues, straight leg jeans, and all that glitters. We will also continue to invest in a brand and category expansion of our assortment. For example, in Q1, we added over 20 new women's and men's brands. Over the course of FY22, we anticipate adding over 50 brands and continuing to test which are traffic-driving products,
sure,
as well as which are more likely basket fillers. Over the course of Q1, national brand Freestyle revenue contribution grew to 19% in October versus 12% in September as we enhanced our assortment as well as points of access. While we see the importance in ensuring we have the right national brands to attract and delight clients, we are also intending to begin to build greater external brand equity with our strongest performing exclusive brands. For example, O1 Algo represents roughly 10% of men's Q1 revenue, and Market and Spruce represented roughly 13% of women's Q1 revenue, both of which enjoy success rates higher than our best national brands.
Let me hear that again.
Second, we are also intending to begin to build greater external brand equity with our strongest performing exclusive brands. For example, O1 Algo represents roughly 10% of men's Q1 revenue, and Market and Spruce represented roughly 13% of women's Q1 revenue,
not bad,
both of which enjoy success rates higher than our best national brands. Second, we are preparing our technology foundation for scalability. There are various elements of our technology that need to evolve to support the next chapter of Stitch Fix. We realize that it will be important to evolve our overall tech platform to help us achieve our goals. This multi-year investment will include a move to a shared services architecture relative to our current separate stacks for each line of business, expanding the real-time availability of our...
Last time I tracked Stitch Fix in a high manner probably is back last year, 2020. They were definitely trying to get into more men's clothing, and then they were also trying to do some international expansion at that time. So sounds like men's is going decent at least.
Data and implementing the next generation of our vendor interaction API. Specifically on the personalization topic, we are now shifting our algorithms to combine detailed client-based feedback on our products and personal style preferences with real-time user behavior in our Freestyle usage. All of these technological investment areas are critically important to where we are headed. It will take time to have them all in place, but it is an investment that we believe will pay off in a big way over the long term. We will keep you up to date on the progress. And lastly, we are building new marketing activation channels for new consumer growth. Historically, we had access to a subset of client acquisition channels as a result of our business model. These include word of mouth, performance-based channels such as Facebook and Instagram.
Yeah, and then looks like Katrina Lake is no longer the CEO of the company. She has this person, Elizabeth, running the company now. She's still an executive chairperson, though, so she still has an impact on the company, but she's not technically running the day-to-day operations. I think that's important to note there.
As well as incentive-based referrals. With the launch of Freestyle and the ability to share our product catalog as a vehicle for consumer engagement, we are now entering into a number of new marketing channels, including Google product listing ads, influencer marketing, and we will eventually participate in SEO. With that, I will hand it over to Dan to discuss our financial results and provide our updated view on FY22.
Thanks, Elizabeth, and hello to everyone joining us on today's call. In Q1, we generated net revenue of $581 million, representing 19% year-over-year growth. We saw continued momentum in women's as well as in kids and in the UK, where we nearly doubled revenue when compared to the first quarter of last year. Additionally, Freestyle has grown 40% year-over-year as we ramp the offering. We grew active clients to nearly 4.2 million, an increase of 417,000 clients, or 11% year-over-year. However, sequential net client additions of 15K were below our expectations. As Elizabeth mentioned briefly, since the full rollout of Freestyle, we have been iterating on new client acquisition and onboarding methods, and that has had an impact on fixed conversion. Also, in the first half of fiscal 2020,
Sounds to me that's why the stock's down big, is because of that only 15,000 new client number. I think that's what's freaking a lot of people out, because the revenue seems good, the margin story's good. The overall story with the company is pretty good, but 15,000 new clients is definitely going to scare a lot of people. Like, oh my gosh, we're about to go negative here, right?
we launched a high dollar value referral program for new customers, which ultimately brought in clients who did not remain active as long as we had hoped. We have since ended the program. However, our net client adds were impacted by this in the first quarter, and we expect to continue to see the effects of this into the second quarter. And finally, we'll continue to face IDFA challenges in both historical and new channels as we evolve our marketing strategy. We expect a sequential decline in actives in Q2 and anticipate actives returning to growth in Q3. We continue to test, learn, and evolve our onboarding process and our marketing channels with the focus on adding new clients that engage with us over the long term. As a result, we're seeing healthy retention and engagement. Anticipate actives returning to growth in Q3. IDFA challenges in both historical and new channels as we evolve our marketing strategy. We expect a sequential decline in actives in Q2 and anticipate actives returning to growth in Q3. We continue to...
That's what it is. I mean, that's the second part of that. 15,000 this past quarter, and then a sequential decline in this quarter we're in right now. That's what's freaked a lot of people out of this stock. They do expect it to get back to growth the following quarter, but now I understand kind of why this stock's down big after hours. Because, that's one of those things people are like, oh my gosh, or could we be in decline the following quarter and the following quarter?
Learn and evolve our onboarding process and our marketing channels with the focus on adding new clients that engage with us over the long term. As a result, we're seeing healthy retention and engagement rates for new and recently acquired clients, which is driving the highest RPAC we have ever experienced. Q1 gross margin was a record 47%, representing a 220 basis point increase from the same quarter last year, largely driven by improved product margins as well as shipping cost optimizations. Advertising was 8.7% of net revenue in Q1 compared to 10.5% in Q1 of 2021. We continue to test new...
I got to say, they deserve some sort of credit for that. The fact that you can have margins go up or to any sort of record levels during this sort of time period we're in. If anything, people's margins are getting devastated right now. Transportation costs is destroying companies. Shipping costs is destroying companies. And obviously just the products in general have gotten much more expensive. So the fact that Stitch Fix is hitting those sorts of margins in this sort of environment, that's something to be actually really, really bullish of, to be quite honest, because it's not the best environment for anything margin related, especially for a lot of the smaller companies. Like Stitch Fix is still considered a smaller company, right?
Channels, including SEM, brand, and influencer marketing. As we ramp these channels throughout the quarter, we opted to not overspend in marketing while we refine our onboarding experience. As we continue to improve onboarding, we'll also continue to ramp our marketing as appropriate to optimize for long-term free cash flow. Q1 adjusted EBITDA was $38 million, reflecting sustained revenue growth, strong gross margins, and lower marketing spend. Net inventory ended the quarter at $184 million, down 13% quarter over quarter. While we continued to add selection throughout the quarter, we did experience delays in receipts, primarily due to shipping delays in the global...
I think that's something that's probably confusing a little folks. They're saying, okay, you're spending less on marketing, less marketing spend, right? Margins are improving, but customers are not improving very much, right? Hardly went up this quarter, expected to decline next quarter. So some people are going to look at this and they're saying, are you cashing out as a business? Cashing out meaning, are you no longer focused on big revenue growth and now it's just time to make money, right? Profitability. And so that drives away a lot of growth investors when they hear something like that, right? Oh, you're not going to spend like crazy on marketing. You're chasing margins right now. Nah, we don't really want a piece of that. Because a lot of folks that have been in a stock like Stitch Fix, they don't really care about the short-term profitability. It's like, hey, if margins come in good, that's great. But they're really about the revenue growth, the new customer growth. And if all of a sudden the revenue growth or the new customer growth isn't expected to be all that, people are like, then all of a sudden you kind of feel like there's a limited TAM there, right? So I think that's something that should be considered.
Supply chain. We are currently experiencing delays from 1 to 4 weeks, and we expect these delays to continue in Q2 and beyond. We delivered $125 million in free cash flow and ended the quarter with no debt and $401 million in cash equivalents, and highly rated securities. Given our strong balance sheet, we are well positioned to make the necessary investments to become the global destination for personalized shopping while maintaining an unwavering focus on managing costs by operating efficiently. As we've shared today, we are in a moment of transformation, which will be a multi-year endeavor. The investments we are making now will allow us to unlock the long-term opportunity that Freestyle presents. As Elizabeth mentioned, we are very early in our journey, especially with Freestyle. In parallel, the apparel industry continues to be impacted by the macro supply chain challenges related to port congestion and logistics constraints. These unknowns have been factored into our outlook. Looking forward, for Q2, we expect net revenue in the range of $505 million to $520 million, representing growth of 0 to 3% year over year. We expect adjusted EBITDA in the range of negative $5 million to $5 million, or negative 1%.
I mean, yeah, that's so disappointing, right? I mean, people are just going to look at that and say 0 to 3% or whatever they said. Oh, I mean, this is a company that people are used to growth of 15, 20, if not over 20%. And you all of a sudden come in, you say you're going to grow, look at what was expected. 17 analysts, 570. I don't even think that was close to 570. Didn't they say just a little over 500, right?
Port congestion and logistics constraints. These unknowns have been factored into our outlook. Looking forward, for Q2, we expect net revenue in the range of $505 million to $520 million.
So that's a midpoint of 513.5, right? So 513 mil. And also expected 570. Oh, man. I mean, even if you're a devastated stock, if you come in with that big of a poor guidance for the upcoming quarter. No, wait, no. This was for this past quarter. This is even worse. This is a quarter they're talking about here. So 584 is expected, and they're talking about coming in at 513 for a midpoint. Oh, gosh. That's awful. Yeah, that's awful, man. That's how you get your stock to go down to another 52-week low. Like they could have probably missed and seen the stock price gone up, right? Just because, when you're such a beaten down dog stock and you're just like getting hit to the floor, you just come in with a little something, as long as it's somewhat close to numbers, and like a lot of times you're rewarded, right? Because you're already priced for so much devastation. But gosh, you can't come in with a midpoint of 512, 513, whatever it was, right? And you're going to get hammered even more. Oh, man, that's disappointing. That's really disappointing.
Presenting growth of 0 to 3% year over year. We expect adjusted EBITDA in the range of negative $5 million to $5 million, or negative 1% to 1% of net revenue. For the full year, we now expect revenue to be in the high single digits year over year and adjusted EBITDA margins to be between 1% and 2%. This guidance reflects our expectation of lower net adds in clients discussed previously as we continue to optimize the client experience and onboarding in advance of accelerating further spend in marketing. It also reflects the ongoing macro impact of global supply chain challenges in the industry. As we've discussed today, we are in the first inning of a long game and will likely take several quarters to start seeing the impact we expect from our efforts. As we continue to learn, we are confident we are pivoting quickly to respond to any challenges we encounter. We remain excited for the journey we have embarked upon and confident that we are positioned well to become the global destination for personalized shopping. With that, we're now ready for your questions. Operator, I'll turn it over to you.
Oh, this is going to be ugly. These analysts are probably going to destroy them with these questions. Just a prediction.
Thank you. If you'd like to ask a question, please signal by pressing star 1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Again, press star 1 to ask a question. And we'll take our first question from Mark Mahaney with Evercore ISI. Please go ahead.
Thanks. 2 questions, please. Could you talk about the impact from Fix Preview, what impact that's had in terms of spend per customer, the number of items, fixes, the number of items per fix that people are keeping? And then secondly, could you go through again the net adds shortfall in the quarter? I got the IDFA part, but the other factor that dragged down in the first quarter and is likely to continue in the second quarter, could you...
By the way, sometimes if you ever hear analysts have a little attitude when it comes to a company that misses earnings big, a lot of times it's because essentially it makes the analysts look even worse, right? Analysts have a hard enough time, getting numbers right. But then you come in with a massive miss like this, and analysts are like, what the heck? You made me look like a dork. I had 585 for your number. Now you're talking about doing 512, 513. Next quarter, I look massively awesome. Or imagine, somebody coming in with a 600 mil number was expected. And then they're like, so sometimes, some of these guys are going to come in with some more attitude when they ask the questions. You can usually kind of tell the vibes, right? Because they feel like management let them down with kind of the predictions. And, what are you guys doing with the business?
Click on that, please. Thanks.
Hey, Mark, thank you for the questions. I will answer those, and Dan, feel free to add on. So on Fix Preview, we really like what we have seen with that experience, and it's continued as we've furthered the rollout. So overall, we've seen increased average order values, largely as a result of higher keep rates. Clients have an opportunity to see ahead, select a few things, and then the stylist finishes the fix, and that's had a positive impact on average spend. We also, have seen improvements year on year on client retention, which we also think can be attributed to the positive experience of Fix Preview coupled with Freestyle. And then on the net ads, we pointed to really 3 different drivers, which we are focused on. So the first is, as both Dan and I mentioned, we're incredibly focused on evolving the onboarding process to Stitch Fix, both for clients that are experiencing and wanting to get into fixes as well as Freestyle. And so we see opportunity. We've already made some adjustments as we've entered into Q2, and just more learning to just make it, frankly, a lot easier for new clients that want to get shopping right away to get into that experience as quickly as possible. The second that we pointed to that I think you were alluding to, Mark, is we've always really had a good client growth from referrals and incentive-based referrals. We tested a program last Q1 and into Q2 of last year that was offering a higher referral fee, and that was something upon analysis we realized was not generating the kind of clients that we want in our ecosystem. And so we've ended that program, but that is having an impact not on the gross ads, but net ads as a result of dormancy. And then the third is kind of the impact of IDFA and the iOS privacy changes, which we're continuing to learn and improve our performance within marketing, just given those changes, similar to many other companies that market.
Thank you, Elizabeth.
Next, we go to the line of Ross Sandler with Barclays. Please go ahead.
Hey, guys. I guess I'll ask about the revenue guide. So you mentioned that you're having all these supply chain delays in getting product, and I know that inventory levels kind of dictate how many fixes and how much Freestyle you can send out in any given day, week, month, quarter. So how much of the decel is related to the client net ads that you just talked about versus not having enough inventory to then fulfill the demand that might be out there? And I guess just stepping back from these issues, how much of this do you think is kind of temporary versus, pretty easily salvageable? Like, could we, get the growth rates back up in a matter of a couple of quarters? What's your view on that? Thank you.
Yeah, thanks, Ross. I mean, maybe I'll start at a very high level, and then I'll hand it over to Dan.
See, this is the issue, and this is what all analysts are going to be wondering here is, analysts expect this company to grow 15%, right? And now all of a sudden, when you have your company basically gonna hardly grow revenues next quarter. Analysts are like, wait a minute, is this company really gonna grow double digits here in the future? How are they gonna turn this around to get back to double digit growth, never mind 15% growth, right? And I think that's going through every analyst's mind that probably covers this company.
I mean, I definitely think we think both of these are temporary. Just the supply chain issues we would expect to subside over the coming year plus. And then onboarding, we're learning a lot right now, and we're confident we're going to improve over the coming quarters. But with that, let me hand it to Dan to give more detail.
Yeah, I'll just add that with respect to the client actives and the impact that has, obviously the client actives in Q1 and as we mentioned into Q2 will have some downstream impact, although we do expect to return to growth in Q3 as we enter the spring season for client ads. So we do view that as temporary, although it does have a quarter-on-quarter effect. In relation to inventory, we do have certain categories that we would like to have more inventory in, not all categories, and that does have an impact going into the back half of the year. We're managing that as tightly as we can by looking at placing orders early and tracking through all the logistics. We'll have to wait and see how that impacts our Q3 and Q4. So back, just to round this out, back to Elizabeth's point, it's really both, and we do view them both as temporary.
Next, we go to the line of Cory Carpenter with JP Morgan.
Thanks for the questions. I had two. Maybe first, I think, Elizabeth, you mentioned in the prepared remarks dealing with short-term impacts of cannibalization. Could you just expand on that comment a bit and maybe what you're seeing on the cannibalization side? And then just in terms of COVID, how sensitive is the business or consumer demand to COVID headlines? Are you seeing much impact at all when cases flare up, or do you feel like we're kind of past that at this point? Thank you.
Yeah, thanks for the question, Cory. So on the cannibalization point, I guess I would think about that a couple different ways. First is we feel really good about the additive nature of Fixes together with Freestyle for clients in our ecosystem. And I think the record high of $524 on our RPAC is a really strong signal of the benefit of having both Freestyle and Fixes, as well as the evidence of category growth rates in categories that have typically been underrepresented by Fixes, like footwear. So that we feel really good that on the long-term basis, we're generating, over time we'll be generating higher LTVs with our clients. The short-term cannibalization that I was referring to is more as we think about onboarding new customers to our experience. Over time, we anticipate generating more traffic to site through both StitchFix.com, through product detail pages, and new channels. But in the short term, people are making a trade-off between, do I want to try Fix? Do I want to try Freestyle? And so that's the learning phase we're in right now that we see opportunity to get better and better at and really grow the overall net ads with our clients.
I've heard enough, to be quite frank. I don't even, this isn't even a company I can, unfortunately, and I was coming into this, I was really hoping like this would be a stock I'd be like, oh yeah. Unfortunately, anything above a $2 billion market cap, I'm not interested in this one. It has to be under $2 billion, if not under $1.5 billion, which is still quite a ways down from here. Just at the end of the day, when I look at this business, I think it's just a mess right now. When all of a sudden you go from you're supposed to grow your business 15% to all of a sudden now, you're talking about this next quarter, 0 to 3%. 584 was expected. You're talking about, 512, 513 million at the midpoint. Your best case scenario, their best case scenario they gave for revenue for this upcoming quarter is 520 million. On a percentage basis, that's a huge difference. On a dollar basis, it's $64 million less. So, and that's a best case scenario they have. So right now, this is a no-touch stock for me. As bad as I really, coming into this, I really wanted to be like, oh, this is awesome, because this is a stock I've tracked for several years, and I really want to come in and say like, hey, this is a next buy. I got to wait on this one. It's too much of a mess. Growth investors don't even know about this. I'm looking at this and I'm like, I don't know where their future's going. So I've got to get it for dirt cheap if I want in this, which is under $2 billion, if not closer to $1.5 billion. Then I'll be willing to take the risk reward there, or wait to hear the next quarterly numbers, because it's very confusing on where this company's going. And who's to say next quarter they're all of a sudden like, hey, you know what? Yeah, we're not going to get back to any major growth. Clients are going to go down again next quarter. Who's to say they're not going to do that, right? So yeah, that's about enough for me with this one. Unfortunately, as much as I wanted to be a buy, anytime I see a beaten down dog stock, I want it to be a buy, but I just can't go there. Anyways, guys, hope you enjoyed this. Let me know if you enjoyed in the comments. Much love as always, and have a great day.